Do you expect, Andy, a moment where this lack of physical metal is exposed in a way that the market can't paper over? I mean, what is the most dramatic outcome that can happen when we talk about this long-standing manipulation, when we talk about how there's so much more paper silver than physical silver? Is there a point where this actually gets exposed, and what would that look like?
Well, it would look like what it looked like to Bear Stearns. And I've talked about this forever, the interview that Bart Chilton did with both Andrew Maguire and Chris Marcus, and then died shortly thereafter. I'm not saying that there is a correlation there, but he came out and said Bear Stearns failed largely because they held the largest short position in silver. This is the head of the CFTC, the Commodity Future Trading Commission, the commodity police, just like the SEC for securities. And he admitted that largely the reason that Bear Stearns failed was because they bet against silver and the price collapsed, and they let them fail. There were reasons behind why they let them fail. They were one of the only banks that didn't play ball with the Fed on something else years before, but evidently that was never forgotten. And so when the price rose dramatically, they collapsed. And this is when you get into the Jamie Dimon thing and all of the stuff that Bart Chilton talked about. It's one of the two videos that anyone who owns metal should watch. But the admission from the head of the CFTC that this is indeed what happened, to me, is exactly what will happen. And if you get a failure to deliver where the Fed doesn't come in and backstop, doesn't make Jamie Dimon and JP Morgan take that position, doesn't paper it over, you get a bank like for example, UBS, who realizes that the derivatives that they took over for Credit Suisse, same thing. Do you think they wanted to take them, or were they asked politely to take them? That those derivatives that they hold are worse than they thought, and you get a bank like that who has a failure to deliver, and the U.S. Federal Reserve doesn't come to the rescue, like the last time these things happened in 2008, and the United States had to open swap lines for the Swiss National Bank to bail out everybody. If they don't let that happen, and you see a systemic failure by one of these banks, a failure to deliver, well, these banks don't just trade in metals, they trade in everything. And you start to get a run on one of these banks, the systemic contagion reaction is like a house of cards that collapses. Could that happen? Yeah, absolutely. And I think that's the mistake that people make, to think that, well, they'll never let that happen. Who's they? And isn't it just possible that when you over leverage a system to the degree that the West has, where you rehypothecate or resell the same piece of metal over and over and over and over again, assuming no one will ever stand for delivery, but everyone does, and you can't get it, what happens? It's the kind of deal whereby they say when you go long, you can only lose what you put up. When you go short, you can lose everything. And it just keeps on going. And I think that is the lesson to be learned, that it could get very, very, very ugly. Now, is it probable to do that? I hope not. But it certainly seems we're getting closer to that point when David Jensen comes on our show and he says to me, Andy, London has 2 billion ounces in contracts that are outstanding for delivery against a 140 million ounce float, which he would himself tell you, well, I question that 140 million ounce float because they had to borrow money from China recently to make good on deliveries at a far less amount than that. So all of these things are, shrouded in a little bit of uncertainty, and it's a little bit opaque, but you can see it is beginning to break. Mm-hmm. That's the same reason the LBMA perhaps said that their market most of last year was T plus 8 weeks when it's a T plus 1 day settlement. Oh, we have a shortage of manpower and trucks. What you are seeing is a system that is fraying. And it started with the folks in the global South who became, motivated, sophisticated, coordinated, wealthy, and said, let's stand for delivery. Slowly, not too fast to blow it all up. Everyone says, why don't they just take it all? Because the exchange would blow up. Everyone would blow up and they'd cut off their nose to spite their face. But whether it be through an $8 premium over the Western price to slowly arbitrage, whether it be for standing for delivery, whatever it is, they're doing it slowly. You see it happening. And it's starting to accelerate. And TD Bank is a prime example. They put this trade in the beginning of January, and 10 days later, they're stopped out. Now, in years past, bang, the price goes down and it never comes back, in conjunction with rising margins on COMEX, which should knock the wind out of it too. What happened? Price fell. The people on margin had to cover their additional premium that they had to pay. They had to sell. The price fell, and bang, it's right back up again, because the people that are standing underneath it are not using margin, and they're looking at any subsidy as a gift, as everyone seems to be racing to secure what is now something for national security, perhaps.
Well, we know that it is, to your point, on the critical minerals list, and we know that central banks around the world have been accumulating gold at record levels. I'll zoom out and get to the macro conversation in a minute, but seeing, as you pointed out, the discrepancy between the East and the West, a very important signal that we're seeing in the silver market is how physical silver in Shanghai is trading noticeably higher than in the West. And we're not talking about a few dollars or a few points here. This has been a very significant difference. So what does that mean when we see that this premium has persisted, driven by the strong domestic and investment demand for physical silver in China? What does that tell us?
Normally, when you have a discrepancy like that, Michelle, arbitrage resolves it, right? But it's not resolving it, because the Chinese say, thank you. We'll pay more for your metal if you have the ability to buy it here in the Western paper and deliver it in physical in Shanghai. Thank you so much. And it's just that sucking sound that you hear is them really, I guess, trying to tempt and tempt the traders to deliver metal to China for a premium, for a profit. And the fact that it hasn't corrected and it continues to say persistent says that this is their plan. They're doing this purposely. They're doing it to incentivize anyone who wants to make that big profit, where you can buy it. You take 5 million ounces, you buy it here, and you deliver it there at $10 an ounce. Well, you just made $50 million. Easy peasy, and the traders are happy. So are the Chinese with the trade imbalance that they have and shedding the dollars, de-dollarization. They don't care that they're paying a premium. They've been mining gold and silver in their own country for years. That was uneconomical because they see the big picture. And geez, look how economical it is becoming now. No, I think that they see a big picture and we don't. And so the traders who are doing this are short-sighted. That metal won't come back. It is being reintegrated into the economy, that being gold and silver. It is critical. And we've known that for a long time. And I guess it's just becoming recognized. Everyone talks about the United States making silver critical. They talk about China restricting exports. They don't talk about two other things that are important, and that a year before that, the European Union designated silver critical, and 2 months before China said we're going to limit exports by permitting all of the very large refineries who would have the ability to do this. They said, we're the second largest producer of silver in the world, and our silver domestic production will be kept for domestic priorities. And so you have a race. This isn't about two brothers in 1980 or about leverage and speculation in 2011. This is about silver being repriced, and it's being repriced through physical demand, not through paper that has created an illusion that silver was really not that important. And I've always believed it has more to do with the military-industrial complex than anything. But whatever the reason is, ask yourself this one question. Why would 8 banks in the West control the largest concentrated short position of the roughly 1,000 commodities traded on COMEX of any commodity in the history of the COMEX in silver? 8 banks in the West, in the US and Canada and in Europe. Why? And it was because there was something far more important about silver than its price would be allowed to explain. And it's disappearing in nature, and it's vital in a advanced civilization, whether that be advanced military equipment or AI or technology, digital, electronic, etc. And that's now being exposed through delivery. You can't paper something over when everyone says, fine, but these contracts say we can deliver. Where's my silver? Then we have a very, very, very big problem. And that is, to me, what is happening. And if the Economic Times is right, following Tom Luongo's thesis, which I find to be quite intriguing, the U.S. banks are net long. Who's left holding the bag? The European banks, banks in Canada. Tom believes that Trump is very upset about the European aristocrats. He believes, right or wrong, that they were involved in election interference. Now, Trump just said in Davos yesterday, that there was election interference, and there is, and there was, and it's proof, and people are going to get indicted over this. I probably shouldn't have said that, he says. There's breaking news. Well, he believes someone was involved with it. Tom Luongo thinks that he believes it was the European aristocrats that stand behind the big European banks. Well, all this metal that's come back, and if the Economic Times is right, and all the 5 banks have flip-flopped and gone long, including JP Morgan, covering a 200 million ounce short position, then where does this go if we see that moment, a contagion, a systemic failure that blows up not just one bank, but a whole series of banks, while the U.S. banks are net long and out of the mix? So I guess we'll see. I'm not saying that's my total belief, but in listening to Tom and looking at the Economic Times and looking at the Commitment of Traders report, the last one showed that the U.S. banks were net long. I mean, it did show that. They'd still have shorts, but shorts versus longs, the U.S. banks were actually, from a percentage basis, more long than short. So technically net long. We'll see what happens. But I think all I can simply say is, look, this time is different. I've never seen anything like this, ever, never. And normally when margin rates go up, normally when lease rates are that high, bang, the market gets kneecapped and it does not come back. It's taking 24 hours or less and it comes right back.